You guys see my screen? Which screen do you see?
The main first page, 2021 Spring Economic Update.
Good morning and welcome to our webinar. Today we are doing a 2021 Spring Economic Update and Investment Outlook. You're going to be hearing from me today, Katie Bruno, and also my partners, Michael Morey and Ben Hoy. We're going to take you through where we've been the last few months in terms of the economy and the stock market, and then we're going to talk about where we think things may be going. To get started, let's talk a little bit about the agenda. And I think that it's inevitable that we start with talking about COVID-19. And I know it feels like every conversation is still centered around COVID-19, but as we are entering a recovery phase, I think it's important that we do highlight where we are. Then we'll talk a little bit about the economy, how the economy has recovered from the pandemic. We'll talk about takeaways from the earnings season and corporate earnings. I'll give a political update and we'll talk about some of the stimulus packages that have already happened and those that are currently being proposed for legislation. And then we'll talk a little bit about the concerns over inflation, and we'll end with talking about why we like stocks and talk about some specific sectors and themes that might fit into your portfolio. If you have questions during the presentation, there is a chat box down at the bottom of your screen. Feel free to type in questions as we go, and we'll be happy to answer those at the end of the presentation. And just one thing that I wanted to mention as we kick off our presentation is that our investment research and our strategies often incorporate information that's provided to us by the Raymond James Investment Strategy Group. And the thoughts and insights that are provided in today's calls include a combination of our thoughts and our perspectives and those of the Raymond James team. And one of the benefits of having Raymond James as an extension of our team is that they are a global firm and they do have strengths and resources that can provide us that critical information that we need to get out to you as our clients. And I know for all of us, they've been a great resource to us as we navigate through the pandemic. So with that being said, I am going to turn it over to Mike to kick us off with a COVID-19 update.
Thanks, Katie. As you're probably aware, a lot has been going on recently in the news with COVID. The CDC just announced that masks were no longer necessary for those fully vaccinated, which is a good news and a trend in the right direction, I hope. But as far as in the US, it appears as though we may be turning the corner. Things continue to improve as the number of Americans get fully vaccinated, and that number continues to grow. So for some reference, if you look at the chart on the left here, this shows Israel, and it shows as once they reached 25% of their population getting vaccinated, they saw a steady and permanent decline in new COVID cases. If you compare that to here in the US on the chart on the right, we reached 25% of the population being fully vaccinated as early as April 18th, and now currently stand at roughly 35% of the population being fully vaccinated. Since April 18th, as it shows, we've seen a steady drop of new daily COVID cases of around 60,000 per day to now roughly 40,000 per day. So while that's still too many new cases, we're definitely trending in the right direction. Next slide, please. Now, as you can see on the chart on the left, the US is currently the leader in the world for vaccinations, with 35% of the population being fully vaccinated, as I mentioned earlier, compared to the rest of the world, which is only at about 4%. At the pace that the US is on, we could potentially get to 70% of the population being vaccinated by the end of July this year, which many experts believe would achieve herd immunity. However, with the world lagging the US in general, it could take the rest of the world well into 2023 before the global population is fully vaccinated. So we still have work to do and aren't out of the woods just yet. If there is a risk here in the US, is that we're beginning to see a decline in the number of daily vaccinations, slowing down from around 3.4 million vaccinations a day to currently 2 million a day, as you can see on the chart on the right. Part of this trend could be that the elderly population, the aging population that was at the greatest risk, were eager to get vaccinated. And now as we start to shift towards the younger demographic being available to get vaccinated, the urgency to get vaccinated just may not be as high. The good news, though, is that in order to reach that herd immunity by the end of July, we need to be on a pace of about 1.5 million vaccinations per day. So we're still on the right track, but that might be something to keep an eye on as the daily rate of vaccinations trends downward. And with that, I'll turn it over to Ben for some information on the economy and the economic recovery.
Thank you, Mike and Katie. Appreciate that. Yeah, so as we look at, let's see, well, there it is. We've got, we've had a full-on economic recovery in process here for a while now. As we look at these two charts, you'll notice that we start off looking at the gross domestic product. And just so everyone's up to speed with that, basically the GDP is the broadest measure of the economy and is a good way to determine, growth versus reduction. So you'll see the last few years here highlighted in the first graph on the left. And the ideal growth that we're really looking for is going to be between 2 or 3%. You'll see much of the time we're within that range. The last few years, we were doing pretty darn good. The decline that we saw last year due to the pandemic obviously was quite the outlier, as well was the recovery that we saw immediately following. So the graph next to that shows the last 30 years actually highlights the, the unlikelihood of being able to see that kind of volatility. So when we look at last year and we see that there was, a huge downswing followed by a huge upswing, quarter 4 of 2020 actually did see a nice steady growth of just over 4%. Quarter 1 of 2021 actually exceeding most analyst projections and hit 6.4% growth. So the economy and the recovery is definitely in motion. There's a lot of great signs that make us feel like the growth will continue. And there, while you hear things in the news about inflation concerns and, even as we're reopening the economy and we hear about some small businesses having trouble finding employees and just some of these, we like to think of them really as more short-term setbacks, but really aren't going to be the types of things that are going to impact long-term growth and we see the economy continuing to grow. So as we look at page 8 here on the next screen, again, this just takes a little bit of a closer dive into some of the things that are behind the growth and things that have been, we've been seeing do very well. For example, retail sales, record pace over the last year. I do like to point out here that some of these numbers are based on year over year. And when we take a look at where we were a year ago, of course, we're going to see some dramatic differences. So you take these year over year results with a little bit of salt there, with an understanding that, we were at some pretty unusual numbers a year ago. So, but then, you look at, we were tracing very well on unemployment for a while. The most recent jobs report was a little disappointing. And again, we feel like there might be some glitches as we're, reopening and people are getting back out there. But most of those things we would consider short-term. As we look at other potential short-term hiccups, we're going to have, like I said, we'll get into inflation a little bit later, things like interest rates, how taxes might impact. But, the fact of the matter is that we have seen over about $5 trillion passed over the last year in stimulus. So, how are some of these things going to impact the economy? Some of those questions remain to be seen, but overall, we're very optimistic, and we do see the economy growing over the long term, and certainly even well into this year. So with that, I'll hand it back over to Katie.
Actually, I'll take it. Looking towards earnings, what a difference a year makes. The chart on the left here, the bottom left, if you look at the first quarter of last year, earnings growth was down 14%. And that's mostly in the months of February and March when COVID first hit and we had the big sell-off in the market. But if you compare that to the first quarter of this year, which we just closed out, we saw earnings growth of 46%. That's a rebound of 60% compared to last year, which is incredible. We also saw historic earnings with that chart in the middle. Now, historically, earnings tend to grow and do well, but this has been a record number with 87% of companies beating their earnings forecast. And to put that into perspective, on the chart on the right, historically, over the last 5 years, companies have beat earnings by 5% on average, whereas that number was 23% for first quarter this year. That's almost 5 times more powerful than the average. Sales also came in strong for the first quarter, with companies recording sales 4% better than estimates compared to the historical average, which is right around 1%. Next slide, please. Looking at some fundamentals, the chart on the far left shows the cash that companies have on their balance sheets right now. It's a record number of cash with about $2 trillion sitting on their balance sheets, which is roughly 500 billion more than there was at the start of the pandemic last year. Because of this cash on the balance sheets, it's led to buybacks and dividends, which is a good thing for economic activity. Buybacks have increased in every sector compared to where it was at the height of the pandemic last year, with information technology companies leading the way. Dividends have increased as well with the chart on the right. In the second quarter last year, there were 43 companies that increased their dividends compared to 119 companies that raised their dividends in the first quarter of this year. This is important to note because historically, companies that not only pay a dividend, but also increase their dividend tend to perform well over the long term. Also importantly, only 3 companies in the first quarter cut their dividend compared to 43 companies in the second quarter of last year. This speaks to the health of corporate America, which continues to improve and is evidenced by these shareholder-friendly activities. Next slide, please. This chart here simply illustrates the correlation between earnings and the S&P 500. And as you can see, as earnings go, so does the S&P. The green line is the historical earnings per share of companies in the S&P 500 going all the way back to 2001. And as you can see, the market or the S&P 500 tends to shadow the trend of earnings for companies in the index. So as the health of companies continue to improve and with earnings continuing to improve and beating estimates, we anticipate the S&P and the market to follow suit throughout this year, the rest of this year, and into 2022. And with that, and for all of our favorite topics to discuss, I'll turn it over to Katie for an update on the political scene.
Great. And hopefully I'm able to tie some of the things that they just talked about into the political update that I'm going to go through. So we just finished April 30th marked Biden's 100th day in office. And we have historically called that first 100 days in office the honeymoon phase. And that's because it tends to be that time frame where the president holds the greatest amount of political capital. And when we look at the results of what's happened in the first 100 days, they have been mostly positive. We have had GDP of more than 6.4%. There have been more than 1.5 million jobs added. And Biden's approval rating is at 54%. Now, this is a better approval rating than President Trump had in his first 100 days, but it is still one of the lowest approval ratings that we have seen in the post-World War II era, and it's the lowest approval rating that we have seen from the Democrats after the first 100th day in office. But it's not unusual for the stock market to rally in the honeymoon phase. And we've definitely seen that. We have had the strongest equity performance of about 11% in those first 100 days of Biden's administration. And I want to show on this chart here where you see the diamonds. At the end of April, we were at 9%. And this is the highest that we have ever seen during the first year of president's for stock performance. And we do think that things are probably going to slow down, especially as we see more political debates start happening in Washington. The next thing I wanted to talk about was the infrastructure. So a few weeks ago, this plan was released to Congress, and it's a two-part plan. In total, it's a $4 trillion plan, and it's made up of the American Families Plan and the American Rescue Plan. And the first part is infrastructure, and this really is your traditional infrastructure plan. This is in addition to the $5 trillion that we have already been appropriated over the last year due to the pandemic. We've seen 3 rounds of stimulus, and there's been a lot of other things packed into those bills that have totaled $5 trillion. So these 2 plans that were released are $4 trillion that's in addition to that. And what this traditional infrastructure plan covers is 621, I think I maybe went too fast. Nope, I didn't. Okay, 620. I had my slides mixed up. 621 billion of it is going to be appropriated to the transportation. These are your bridges, your highways, your roads, your airports. And then 480 billion of it is going to be appropriated to manufacturing. And we know that we have concerns over supply, and we're seeing supply issues in spaces, especially like the semiconductor area and chip manufacturing. And so one of the questions that we're going to have going forward is, how do we invest in the U.S.? And is this the plan that allows us to invest in the U.S.? There's also some money in here that's meant for housing, and we know that housing is one of the strongest parts of our economy right now. There is a lot of demand, and there is not a lot of supply. And so this is really about catching up the supply to meet the demand and filling that gap. And then there's some other money appropriated in there for water and broadband and education. Now I'm going to go back here a slide, because I did have my slides out of order, to the American Families Plan. And this is the plan that focuses on providing money to the Americans to spend and paying for some additional things throughout. So one of the things that I'm sure a lot of you are already aware of is that it did extend the child tax credit. And so starting in July, Americans that meet an income threshold are going to get a monthly check every month from July to December of $300. And it totals $3,000. It's $3,000 per child for kids who are 7 to 17, and $3,600 for those kids who are age 0 to 6. This was passed as part of that COVID relief bill that was in March. In this bill, the American Families Plan, this is asking to extend that to 2025. And this part right here is probably one of the most critical pieces of the American Family Plan legislation, because the Democrats are really going to push for this one to happen. Also a part of that is some 4 years of additional school, 2 4 years of additional school paid for by the government, 2 starting before kindergarten, so preschool, and 2 starting after high school, so 2 years of free community college. And then there's some other extensions to federal programs that are already out there. You'll notice here that on this, there is $80 billion for IRS audit and enforcement funding. I do want to talk about this for a minute because this is money that is wanting to be appropriated for enforcement to the IRS to collect taxes that are out there. So what they are, what the Biden administration is proposing is to give $80 billion to the IRS, and that will allow them to collect the more than $700 billion that's out there that's owed in tax. And this is existing tax laws that has gone uncollected today. And so this is going to be an important discussion in the overall topic of how we're going to pay for these bills. So I'm going to go on to this slide, which talks about how we're going to pay for it. This slide right here goes over what the president's proposal is on how to pay for it. He's laid out 2 plans, and one of them is to recapture this money over the next 10 years, and one of them is to recapture the money over the next 15 years. And so some of those key proposed changes are changing the international tax code, changing the corporate tax rate to 28%. This is probably on the really high end. Getting our Congress to meet in the middle, the highest it could probably get is 25%. I think that's the highest that we could see the corporate tax rate go. And then some changes to the individual tax provisions. So eliminating the step-up basis. So the step-up basis is the tax that is paid from selling investments that you inherited. And so what they would like to, what happens today is that when you inherit assets, your cost becomes the price of the investment on the day that the person you inherited it from died. But what this would propose is that we change that, and so that you would pay taxes on all of the earnings from the day the person had originally purchased the asset. And then changing the individual tax rate. Right now, the highest individual cap rate is 37%, so that would be raising it to 39.6%. And you'll notice here that in these 2 columns, this is the amount of money that these changes that are being proposed would generate to the U.S. And so how are we going to pay for the infrastructure plan? This is how they're proposing that we pay for it. Now, you'll notice something interesting here, and that's that when you change the capital gains tax for incomes over $1 million, it actually loses money. And so it would be better if any legislation that was passed was at a set capital gains rate. Now, everything that we have heard up until this point has been for people who make more than $1 million. I know that when Biden was first elected, there was a lot of conversation around the income being for people who make over $400,000. It's more likely that these tax changes are going to be for people who make more than $1 million. Now, in the near term, it's important to remember that the final decision doesn't rest on the Biden administration, but on the House and the Senate. They're who is going to be able to approve this legislation. And then I'll just make a couple broad comments about what's happening in Washington. The message right now is that there is an incredible amount of uncertainty and that there is no master plan with either party. Balancing the market has been a concern because of this, and we're all wondering, is there going to be a partisan bill or a bipartisan bill, and what does that look like? The more likely plan is that there are going to be higher taxes and there is going to be more spending, but it's probably not going to be top-end taxes and top-end spending. In the Senate, we need to, a lot of focus has been on the Senate with the 50-50, but the real focus should probably be looking at the House. The Republicans have a 2-House margin right now because they lost a couple of Democrats to moving to the Biden administration, and there was a death, which is going to make it more difficult to pass some of that legislation that's being proposed. And I am going to turn it back to Ben to talk about inflation, which is another concern that comes along with all of the spending that we're doing. We know that consumers are concerned that this is going to lead to inflation, and I'll let him talk about that.
Yeah, thanks, Katie. Yeah, there's concern regarding inflation currently. Now, and a lot of it does stem from uncertainty. When we don't really have a blueprint for recovery from a pandemic, but there are some things that maybe you might expect to see. And while, I don't want to jump to the final numbers here right away, but even just by looking at the graph here, you can see that, the ideal, again, range we're looking for on inflation is usually between the 2 and 3. And for the most part, you do see the lines hovering in that area. And then, of course, you see the downturn there, when COVID hit. So it decreased some demand. Inflation was very low. And then now, as the economy's reopening, we're seeing more consumer spending, and we're seeing a spike in inflation. So really the idea is, okay, so is this something we need to be worried about? Do we need to make adjustments? And that's where I'll speak to. For the most part, we are seeing a lot of these as temporary, near-term issues. So, it's not necessarily expected exactly the way, you may have thought, but the type of volatility we're seeing, considering the circumstances, really is something, again, that even the federal government is willing to step back from, and they're not looking at making changes at this point. So the chart here, like I said, just to reference that, it is showing the the consumer price index, the CPI, which really is the most widely measured tool for measuring inflation. Basically, it's looking at the price of everyday items like groceries, clothes, activities, even energy and housing costs. And again, just to get a feel for inflation, basically what we're looking at here is that's when the consumers are able to buy less with every dollar they spend. So that's why we're an average amount from 2 to 3 is good and healthy, and that's what we're shooting for. Like I said, when we're looking at year-over-year numbers, and we're looking at where we were sitting last year, the April report that just came out shows a 4.3% increase year over year, which is, an incredibly large number. We haven't seen a number like that since 2008 during the Great Recession. So it does raise some flags, and people become concerned. But again, we want to just point at the fact that the number is a bit distorted, just again, considering the circumstances of where we were at last year. So with that said, there is another tool for measuring inflation, the personal consumption expenditure, the CPE, which, that's slide there. Well, this is really looking to track the changes in prices of goods and services. So basically prices, how are those looking? And anyone who's been looking to buy or sell a home knows that, prices are up in a lot of areas. Used cars are hard to come by these days. So even, Katie, to your point, you were talking about keeping up with home demand and building supplies. I mean, we've seen lumber just kind of going crazy here. I think they're currently up over 120%. So we've definitely seen some increases in the CPE. But it kind of reflects exactly what's going on with the CPI, in that, when we look at the year-over-year numbers, it's really, you kind of keep that grain of salt to understanding where we were at. So you look at the reopening, and again, the flooding of consumer spending, people getting out there ready to spend some money, and we're seeing the effects of that in some of these numbers. So I do want to point out, that even though there is this uncertainty and some of this volatility, when we're looking back at the CPI and we see this 4.3% year over year, what's going on, we take some comfort in knowing that the federal government, hasn't been reactionary. They're okay right now. And we're in agreement with that. We remain confident that, when the dust settles, the CPI is going to settle, around the 2% range by the end of the year. And so, yeah, I mean, just with the unique circumstances that we're in, it does present, some initial concern, but really when you dive into the numbers a little bit better and get a feel for what they represent, for the most part, we're still feeling very, very good and comfortable with where we're at concerning inflation. So, and that will take us on to where to turn.
Yes. So, and I'll just add to the conversation on inflation, and that for there to be inflation, it has to be a long-term thing. And what we're looking at right now is very short-term numbers. And as Ben said, we have the Fed, who is helping manage the situation using monetary supply. And then we also have this supply-demand issue that we have to catch up with. We've had a lot of manufacturing and production sites that were shut down due to the COVID-19, and they just have not been able to meet the consumer demand that's out there right now. And so those are going to be some of the key things that we have to look at to know if we really are in an inflationary environment. But if there is inflation, how do we hedge it? And historically speaking, if we were to go back and look at what asset class has outperformed inflation, we're going to see that it was equities in the stock market. This chart here shows the stocks since 1971. And if we look back when inflation was anywhere between 1% and 5%, and that's what's in this box here, and I know that's a very wide range of inflationary numbers, but when we break that down and we look at what inflation was and then compare it to what the equity market did, the equity market was the place you wanted to be inflation. When inflation was between 4% and 5%, on average, the stock market performed 19.2%. And I pulled this chart in here, and this is a chart that's put out by First Trust Investments, and this just shows different assets going back to 2007. And stocks is the blue line, and gold is the orange line, and then this line right under that is cash. And this gray line is inflation. And so we can see going back to 2007, and the stocks are represented by the S&P 500. The S&P, or the stock market, has been the place where you've been able to get the most return from investing your money. So one of the questions then becomes, do we look at individual stocks or certain sectors when it comes to putting our money in the stock market? And this chart on the left shows results from a small business survey that says 34% of businesses expect to raise their prices over the next 3 months. The question will then become which businesses can actually raise their prices and still have consumers pay for that. And so we start looking at sectors that have profits and also dividend strength, dividend growth. So you'll remember at the beginning where Mike talked about all the companies that have been raising their dividends. So if we put sectors on a graph with profits and then those who are growing their dividend every year. There are three sectors that really stand out here when you look at those simultaneously, and those are tech, financials, and healthcare. And so when we think about technology, technology is a sector that just continues to reinvent itself. And that gives them premium pricing on their goods and services because they're always releasing new and innovative products and services. In terms of financials, if inflation does pick up, we are going to see higher interest rates, which will increase margins for those financial services companies. And then healthcare. Healthcare is an opportunity because there is an inelastic demand for healthcare. We all need healthcare. And especially when we look at the aging demographics across the US and across the world, the need for healthcare isn't going to be going anywhere. And so these are, three sectors that we think would be beneficial to own if you were looking to hedge inflation or if inflation continues to go more than we have expected it to be. And Mike's going to wrap us up here with just talking a little bit about past sector performance.
Thanks, Katie. I really like this chart. I always have. I like to call it the grandma's quilt chart or the table of elements chart. What this shows is, excuse me, the different sectors of the market and how they've each performed from one year to the next. This chart goes all the way back to 2010. And you can see there's really no way to predict which sector is going to perform well from one year to the next. But more recently, if you look at going back to last year, 2020, there on the right side, the top performers were IT, technology, consumer discretionary, and communication services, whereas the worst performers towards the bottom there were financials, real estate, and energy. But again, I like this chart. It just kind of shows that there's no guarantees, and nobody has a crystal ball of which sector is going to perform better from one year to the next. Sorry, Katie, could you go back just for a second? What I wanted to mention here is if you look at 2020, but then look at the far right column year to date and who the top performers are and who the worst performers are, it's basically flip-flopped. So some of the worst performers this year so far were the best performers last year: information technology and utilities, consumer staples. Some of the best performers so far year to date, financials and energy, were two of the worst performers last year. So everything ebbs and flows, as we see here. Okay, Katie. This chart just illustrates that same ebb and flow. If you look, it shows performance in the gray charts from December of 2019 to basically all of 2020, November of 2020. And then in the green bar shows performance of those same sectors from November of last year to present, to year to date. And it's pretty telling. You can see at the top of the chart there, all of these sectors that were just hurt the most during the pandemic of 2020 last year. Energy, airlines obviously were impacted during the shutdown, retail, and then hotels, resorts, and cruise lines obviously were impacted dramatically during the shutdown. And at the bottom there, you can see the ones that performed better last year. On the right-hand side, you got healthcare has done well, technology has done well, but again, year to date, that's flip-flopped, and you see the sectors that performed poorly last year are now some of the top performers this year. So with that being said, we've covered a lot of information here and discussed a variety of topics in general. However, this information alone is not a personalized investment strategy. Keep in mind that investing involves risks and there are no guarantees. If you haven't recently or simply need to get started, we encourage you to sit down with your financial advisor and discuss these topics. This helps your advisor really understand your situation, your fears, your risk tolerance, in your time horizon and to help develop a long-term financial strategy that is appropriate for you. If you'd like to discuss your strategy, please give us a call. We'd be happy to have a conversation with you and sit down and develop a strategy for you. We'd like to thank you all for attending today and for your time. We hope you found this insightful and took something away from it, and we look forward to doing this again with you in the future. Thank you.